There was a great, and I don't have the quote. I can't quote it word for word, but in a piece about governance that I read a long time ago, there was a great point made by Callan, Callan, as a consultant that works with a lot of pensions, defined benefit, defined contribution, and they were talking about the types of people that need to be involved in the oversight of endowments or large pools of money like defined benefit plans. And what the point they made was that the investment world is often very counterintuitive and contrarian to what you would see in the standard business world. If you run a company, you are going to allocate more capital to those areas of your business that you think will generate higher levels of incremental return and free cash flow down the road. So and as well right now, if you have some money losing divisions, you'll probably be looking to either restructure, sell, or eliminate those from your total profile of business lines, right? In investing, when you're managing a portfolio of assets, you usually want to be allocating capital away from what has done well. So if equities have really run, and like they did this year, or venture capital and private equity, not that you can sell those easily. So not a wonderful example, but if you have a year where equities are up 30 or 40%,
yeah,
what you don't want to do is then sell other areas of the market that didn't do well and plow more into what just did phenomenally, and maybe was somewhat anomalistic in its performance. You rebalance away from that and take some of that money off the table. And that is a very counterintuitive move when you think about how assets get managed in the investment space relative to the rest of the business world. And it's hard to do. Are we taking money off the table too soon? Should we leave it out? And that's where the long-term perspective comes in. What kind of a risk profile is there after those runs in the assets, and what do we do? And that's the challenge.
Well, and I think just to put some numbers here, let's say that you've got a long-term target of let's say you want 60% of your portfolio to be invested in equities and 40% to be invested in bonds. Okay, that's your goal, and you believe this because this is the asset mix that is sufficiently diversified to sort of match your ultimate constituents' best interests. Okay, so if you have a 2-year run where equities are just doing spectacular and bonds are doing okay, well, what's going to happen to your portfolio? Well, you're no longer going to be 60-40. You might be, just because equities have performed well, you might have 75% of your portfolio allocated to equities and 25% allocated to bonds. Well, stepping back, from an asset allocation standpoint, it's not a prudent investment to be that heavily tilted toward equities. And so that's when you sell the equities. And so this word rebalance that you're talking about, that's what's going on here. Now, I think it's easy for someone from the outside looking in to say, okay, well, that means they think equities are bad because they're selling equities. No, that's not the case. It's not a statement about whether you think equities are good or bad. It's a statement that you believe that it's in your client's best interest to be diversified at this level where you're 60-40. And so you've got to sell some of those equities to get back to that risk profile. And so it's
no, that's exactly it. And again, it's one of those things that it's there's not a simple or even simplistic formula to attach to that. That it's some people will have a target asset allocation. Some institutions, I should say, will have a target asset allocation. Then they'll put bands around the various sub asset classes. Then I say, look, if equities get beyond, go back to kind of the simple makeup of a 60-40. If equities get to be whatever, 10% higher, so 66, keeping it simple, we're going to automatically rebalance back to, be within that band. If we're still comfortable with equities and the economic environment and so on, we might just rebalance back to the 66. We have the latitude to go to that, but we don't want to go beyond it. You might have others who say, no, we're not going to have hard bands around this, but we will, with the committee and so on, be looking at when and how to rebalance. And so it's a bit less mechanical. So there are different ways. There are different ways to do that. But you're right; it is absolutely not a negative call on equities. Somebody might say, "Look, we still think that the overall environment is flush with liquidity. Valuations." I'm not saying this is applicable to us right now, but valuations are reasonable, and the economic environment is still reasonably favorable. Companies are still seeing, a growing top line as well as operating earnings and whatever you want to come up with. Say we're comfortable holding more than our long-term target, but there will be limits at some point. And what'll drive that a lot of times is, again, going back to what we started the discussion with, what's our long-term risk reward profile to keep it simple for this portfolio? If we were to allow the portfolio to go to 80% in equities because they were doing so well, and then we had a downturn, your drawdown, your potential decrease in value is more often than not holding all the things constant higher because you have a lot more stock than you used to. And typically the volatility and the drawdown range is greater than that of bonds. And again, we're talking about high quality bonds, not high yield. So what does that do to the student? What does that do to you when you're trying to budget? That's where we're constantly trying to manage that asset allocation with the long term in mind, taking into account short term. I don't want to call it fundamentals, but just what our upcoming liquidity needs are and so on. So it's a process of constantly slaloming through processes that are in place to help manage human behavior and serve as a governor, as well as allowing flexibility to take a look at opportunities that might pop up here and there, and then how does that fit within the risk profile? So it's a constant process that doesn't become rote ever. So from a student who's interested in investing in finance, there's never a dull day when you're dealing with a wide range of assets. If somebody wants to dig into financial statements, I'd recommend high yield and equities. If that's where they love to spend their time. So just a quick anecdotal thing here. When I began my career, and this was in the late 90s, like everybody else who was interested in asset management, I wanted to go into equity research, work for a mutual fund, something like that. I ended up moving over to the bond side. And I thought, oh no, because I got moved over to the bond side. I am so glad that I did, because I learned a tremendous amount working with the debt component of the capital structure of companies, as well as all the structured credit markets. And I never thought I'd be doing asset allocation. And now I am. And it's been more interesting than I would have ever imagined. So it's worth a look. And, if a person's interested in finance, it's always, as I said, never a dull moment in any of these areas.
Yeah. Well, just real quickly, I want to touch on one other thing. I know that your group is actively starting to hire some of our students for like a little brief mini internships during the semester. What types of things are y'all going to be looking for going forward, and what can our students be thinking about for those types of opportunities?
Yeah. So what we're having, and what we'll have folks do, will become more formalized over time, because we're still pretty young in terms of having grown to a team of 4. We were a team of 3 before this. And we had a couple of students come through from the business school who were guinea pigs for all intents and purposes, but did learn some stuff as they went through that with us. So they're doing, so the person is doing, a couple of people are doing it in the upcoming semester, and one person now loading portfolios into Bloomberg for the equities, at least initially. Maybe we'll do some on the debt side as well. So this is the actual manager portfolios with whom we invest, looking at the stocks, looking at the diversification within those portfolios, stress testing on Bloomberg and some of the analytics there.
So, by the way, so Bloomberg's a valuable skill, right? Because we are actively teaching kids about Bloomberg. We've actually got we've got a 1-hour intro to Bloomberg, and then now we've just rolled out a 2-hour Bloomberg Advanced course. So those trainings are becoming popular, and I think they're that as you are indicating, these things are very, very useful in the profession.
Absolutely, they are. And so the things that, if a business student wanted to look at doing an internship like that with us or anybody else, making sure you get the requisite finance and accounting classes in. And I remember asking that very question myself. I was a liberal arts guy, undergrad, then I worked nonprofit. And in my first year of business school, I went to one of the professors and said, should I take finance now or should I take it later? And he said, what do you want to do? And I said, investment management. He said, you got to take it right now. And so first semester, first year, bam, I'm taking it. So I would say getting some of the finance classes in early and the accounting classes, it provides familiarity with the vernacular and the concepts, and that's key. Beyond that, I mean, we're not going to be looking for people who've already developed an expertise in Bloomberg or Visual Basic and Excel. I mean, we're not trying to do heavy duty quantitative modeling or using stuff in Bloomberg that's arcane and only is done by a handful of people. That those basic skills will cover it. And then a real interest, I think, in financial markets and investing in general, whether it's bonds, whether it's stocks, whether it's asset allocation. Those are important as well, just because it's just like anything. If you want to go into marketing, probably the internship we're running here is not really where you want to look. It's just so far afield from how you'd be focused. If you want to go into accounting per se and audit work, it could be relevant because we have a heck of a lot of accounting to do, but I'd encourage somebody to go and look at an accounting firm before us. I'd say this is more folks who are interested in capital markets, security analysis, and including financial statement analysis for valuation work and all that kind of stuff. This will help give a lot of context to that, even if they ended up going and working for a mutual fund later. I don't know whether you all offer this or not, but I think one of the things that really helped me later after I graduated from business school was taking advantage of some of the training programs that are out there for anybody to sign up. They're not cheap. They're about $500, but Wall Street Prep is a service that trains investment banking analysts.
Yes.
Training the street. Those programs you can purchase on your own and work at on your own. And they're basically teach you how to build an entire set of integrated financial statements.
Yes.
Complete with valuation work. And so that would be something else I'd say would be useful. We don't go to that level typically because we're dealing with managers who do that for us in essence. But it would be a useful skill to understand how our managers are looking at investment opportunities, regardless of whether it's, stocks or bonds. Obviously not treasuries, but corporates. So that's what I'd suggest for folks who are looking at this.
Absolutely. Yeah. Well, wonderful suggestions. And thanks for your time today, Rip. Thanks for all that you said. Thanks for being a partner here at the university down the street, and look forward to talking to you again.
No, it sounds good. And we appreciate what you guys are doing. And if you all have questions, yell at us, and we look forward to having more of your students show up here to crank away on the analytics. So it's been a good partnership, and we look forward to continuing it.
Absolutely. All right. Thanks, Rip.
Hey, thank you, Eric. Take care.